Welcome back. Let's talk about Accenture, which reported their numbers on Friday and the read-through for the Indian IT companies. As we've been highlighting, Accenture's Q1 numbers were very strong. Revenue growth of 15% is ahead of the company's own guidance. FY23 top-line growth guidance has also been maintained at 8 to 11%, which is fairly positive given the macro uncertainty that we're living in. But the way Street is reading it, that despite strong Q1, the company has not upped its guidance, which basically tells you that they're expecting growth to decelerate in the second half of the year. What's the read-through for the Indian IT space? Ankit Pande, the lead analyst of technology at ICICI Securities, now joins in. Ankit, morning. First, the top three takeaways and the impact on Indian IT.
Hi, Rima, morning. So basically, the first impact would be the kind of revenue growth slowdown which Accenture is building up into the second half of its year, right? In second half of FY22, Accenture almost did a revenue growth of around 25% YOY on CC levels. And in second half of FY23, we are seeing the revenue growth guidance just implying a growth of around 5.6 to 9.6% on a YOY CC basis. Okay. Second is, Rima, since last 3 quarters only Accenture, before prior to 3 quarters, Accenture used to hire around 50 to 55,000 of employee per quarter. So since last 3 quarters only, we have seen massive moderation in employee hiring only. And now employee hiring just stands at around 10,000 to 11,000 levels. Pre-COVID, the employee hiring was between at around 7 to 8,000 level. Okay. The third indicator would be there is a clear slowdown into discretionary revenue also of Accenture actually. As you know, Accenture gives revenue growth of managed services, which is outsourcing, and then there is its consulting business. Okay. So this time the consulting growth also was quite softer actually. I mean, since last 4 quarters, consulting growth was between 25 to 32%, and this quarter it has just moderated to around 10% on a YOY CC. Okay. Thirdly, for the first time, we saw a bit of caution coming in Accenture commentary also, like management have highlighted a weakness into retail, consumer good and CMT verticals also. Indian IT services companies also have called out weakness in this vertical. Okay. Fourth would be, this time they clearly mentioned that client focus is shifting more towards large cost transformation capabilities deal towards takeout deal actually. Okay. So that is one positive tailwind for large cap Indian IT players as these guys have higher market share into cost takeout deals.
All right. Hi, Aniket. Good morning and thanks for joining us. So, you were talking about the revenue moderation. They're sort of building up for a slower H2. Do you think that this is pretty much a theme that we're going to see across the sector, or is it a little bit more divided with the larger IT companies versus the smaller ones? How do you expect that to pan out?
No, actually, this would be similar to almost all the entire pack actually. Okay. Because you are seeing weakness coming into software and SaaS player also. Okay, so basically, if you look at the cloud capex also, right? So cloud capex can be considered as a lead indicator of future cloud migration demand. Okay, in this Q3 CY22, basically consensus estimates for Microsoft and Google were at around 7 to 5% below the expected cloud capex actually. Okay, so we are clearly seeing moderation in cloud capex. Secondly, this time for the third quarter consecutively, the cloud revenue growth of hyperscalers have moderated again. Okay, so going forward now from here on, there is entire softness which is already coming up into SaaS player in US and also into cloud capex player and also into hyperscalers. Okay. I think this is all going to reflect on Indian IT services also.
Aniket, wanted to get your thoughts on the price action we could see in Indian IT space. I believe your view is that the Indian IT companies' performance, financial performance and commentary is likely to weaken over the next 2 quarters. Tell us what your hypothesis is. What's the extent of earnings downgrades or PE derating we could see, and what's the best way? Is right now IT a complete avoid and wait for an entry point, perhaps 6 months down the line?
Sure. So my sense is, Rima, from this quarter onwards, you will see management commentary more weakening as compared to earlier quarter. Like last quarter, all managements were just highlighting weakness into its retail vertical. Okay, now from here on, retail, CMT, manufacturing, a bit of BFSI also weakening will start on actually. Okay, and the impact on revenue growth, Rima, would be visible in Q1 and Q2 of FY24. Okay. So that is on revenue front actually, and as you are well aware that Indian IT stocks multiples are more sensitive to revenue growth as compared to its EPS growth. Okay. Second thought, sorry, second.
Wanted to get your thoughts in on the price action. Are we likely to see a sharp correction in IT names, the extent of earnings downgrade, and is there more PED rating in store?
Rima, right now Nifty IT index is trading at around 22.5 times. Okay. So this is still trading at around 35 to 40% higher than its pre-COVID multiples. Okay. Your revenue growth is nearing to about pre-COVID levels from next year onwards. Okay, your margins are already below pre-COVID levels. Okay. Secondly, Rima, there is not just weakness coming into large deal wins actually. Okay, there is also weakness coming into shorter deals also. Right. So in last 5 to 6 quarter, all these IT companies have massive market share gains where every enterprises wanted to focus aggressively on B2C spends actually. Okay, which were creating a lot of small deals on the table. Okay. Now that delta from those small deals also would not be visible, and neither from the large transformation deals would be visible. Okay. The delta mostly will come from cost optimization and cost takeout deal. Okay. But let me tell you, these deals are generally lower margin in nature. Okay. So my sense is that still according to my revenue estimates are completely factoring US recessionary environment. We are not expecting a soft landing in US in FY24. Okay, so let's take example. My revenue estimates for Infosys stands at around 7.5% USD dollars actually. Okay, and when it comes to margin, Rima, now as you are seeing complete moderation in demand happening, there is supply side pressures are completely waning off now. Okay, so from here on, you won't see any big margin headwinds coming on to the IT stocks, which will also reduce the EPS cut actually. Okay. So yes, there would be cuts coming into revenue growth estimates, but flowing down to EPS, according to me, the cuts would be far more lesser as what we saw in last 4 quarters. Okay. So I think still 5 to 6% EPS cut would be there in this sector from here on.
All right, Aniket, we're going to leave it at that today, but thank you very much for joining us and taking us through Accenture's earnings and as well as what this could really translate into for Indian IT companies. With that, we are going to slip into a short break.